Hi, this is Andy Hoffman, Media Director of Miles Franklin Precious Metals, in our 25th year in business. It's midday, Thursday, September 18th, and this week's audio blog is titled Money Printing, Economic Collapse, and Secession. And no better time to tape on this, one of the most important days in modern history, the voting of Scotland as to whether it should secede from the United Kingdom after 307 years of union. I'm going to try to keep today's podcast short, but not to worry, sweet, as frankly I'm exhausted. When I started at Miles Franklin 3 years ago, I was taping no more than one podcast per week. Today, the Miles Franklin blog has become so popular, I'm taping 5 on average, while Bill Holter's popularity has risen at an equally parabolic rate. Consequently, David Scheckman is able to phase out what has been 15 years of nonstop commentating, although our ace in the hole continues to eschew his wisdom at least once a week. Remember, everything we write and every public appearance we make is 100% free. Free to watch or listen to on the internet, free to distribute, and free to comment on our blog. Our goal is to educate the public of the truth of the global economy and financial markets, which we believe we do better than just about anyone. And in return, all we ask is that if you are considering a buy, sell, or trade of precious metals, or for that matter, using a world-class offshore storage facility, that you give Miles Franklin a call at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Remember, not only is it my job to dialogue with fellow truth seekers, particularly regarding precious metals, but it's my passion. Okay, on to business, where it's getting increasingly difficult to find a focal point given the ongoing acceleration of the global economic and geopolitical collapse. Clearly, the obvious economic choice would be yesterday's joke of an FOMC meeting, which, as always, was more dovish than anticipated. Heck, even CNBC and Goldman Sachs said so, despite their blatantly transparent mandate to portray the Fed in a hawkish light. Let's face it, given the Ponzi scheme nature of fiat currency regimes and unpayable nature of America's exploding debt edifice, let alone of the entire world, there's not a chance in hell the Fed could ever materially raise interest rates, if at all. True, they can BS about tapering the level of stimulus so long as its open market operations desk and the PPT and the cartel maintain a picture of market stability. However, they can never stop stimulating, and certainly not covertly, as they did when the mystery Belgian buyer showed up just as China started dumping treasuries last winter. Again, we cannot emphasize enough that the Fed is not about helping the economy, but the financial markets, which, as it turns out, benefits the bankers that own it and the politicians that appoint its officers, but decidedly not the 99%. I mean, seriously, its dual mandate is to keep unemployment and inflation low. Yet, regarding the former, labor participation and real wages are at 4-decade lows. And regarding the latter, the American cost of living has never been higher. Yes, the stock market hit all-time highs, unadjusted for inflation or survival bias, of course, but given that CNBC just hit a 21-year low in its ratings, clearly very few are benefiting. As for the economic recovery they have been spouting about for 6 years, which, by the way, makes it one of the longest recoveries in U.S. history, the only place we see actual improvement, with quotes around it, is in island of lies data like jobs numbers and diffusion indices, the latter of which even Wall Street characterizes as iffy at best. Heck, Monday's Empire State Manufacturing Index soared from 14 to 27 in August. Yet, like last week's Chicago PMI, its employment component plunged. As for the jobs numbers, we're told that weekly jobless claims hit a new low last week, despite the fact that since 2008, their relentless plunge has coincided with an even steeper plunge in labor participation. And oh yeah, just last month, the BLS reported one of its worst NFP reports in years. Last but not least, housing's biggest propaganda machine, the National Association of Home Builders, reported its highest sentiment level in a decade yesterday, while simultaneously mortgage purchase applications plunged to a new 14-month low. And did anyone see today's horrifying plunge in housing starts and permits, dovetailing with other real housing data such as home sales, inventory levels, and prices? But don't worry, we're told housing is recovering, and also that U.S. deficits are declining, despite the fact we just hit a cool trillion in year-over-year national debt increase, with several weeks of end-of-year spending crammed into them to come, let alone countless off-balance sheet items not reported as debt. As for the rest of the world, things literally couldn't be worse. In fact, I believe that, aside from a handful of weeks following 9/11 and the immediate aftermath of the post-Lehman environment, the global economy has not been this bad since the Great Depression. And sadly, it's getting much worse, as evidenced by horrifying economic data everywhere from China to Japan to Europe to South America. And of course, the United States, if it ever allowed its data to be published correctly. Things are so bad, in fact, that China announced its second QE program in 6 weeks yesterday, following the ECB's desperate NERP and QE announcements 2 weeks ago, and a growing consensus that when Abenomics terminates in April, it will need to be doubled up. Regarding the latter, the yen finally broke below more than a year of post-Abenomics support at 105 to the dollar, collapsing to nearly 109 this morning, and thus likely fostering another massive dose of inflation to a nation already sporting its highest CPI growth in years, its highest debt in the history of mankind, and the lowest economic activity in decades. I continue to believe Japan will be the first world nation to experience hyperinflation, as when I wrote last year's Real Yen Bomb Starts Now, I specifically cited a break above 105 as the point of no return. Of course, Japan is not the only nation experiencing a collapsing currency, per what I wrote in this morning's article titled Nothing. As follows. The past month alone, the so-called dollar strength we soundly refuted in last week's If a Nuclear Bomb Destroyed Europe, which of course has not dented America's record cost of living one bit, has catalyzed dramatic global currency devaluations, as we warned of in last week's article, the single most bullish precious metal factor imaginable. In South Africa's case, its central bank chairman was forced to step down this morning, while in Russia, a record low ruble against the dollar is sure to yield retaliation from the man who hates America more than any other. And as for the collapsing euro, taking with it the pound and Swiss franc, it will ironically catalyze the very inflation Goldman Mario so badly wants before ECB QE even starts. Speaking of the pound, nothing I have discussed above compares in importance to today's Scottish independence referendum, which, whether or not it passes, and at this point it's a toss-up, is indicative of the growing global secessionist movement I wrote of last week and first predicted 3 years ago. The fact that Scotland is choosing now, after 307 years of union, is particularly telling, given the UK stock, bond, and real estate markets are at record highs. As Simon Black of The Sovereign Man noted yesterday, human nature is resistant to change, and thus, the fact Scots are voting for what will likely yield a near-term economic cataclysm should tell you loud and clear how the 99% feel about the recovery propagandized by the 1% running the UK, nearly all of whom, I'd guess, are English. If they vote yes, the battle for North Sea oil revenues will be so fierce it could catalyze decades of economic and diplomatic war. Scotland claims that 90% of such revenue is theirs, and don't think for a second the English won't fight them to the death for it. It's their history. That's what they've done for 1,000 years. Worse yet, the resulting chaos will tear England apart, of which, I assure you, few of the billions of people London has disenfranchised over the centuries will be shedding any tears. More importantly, it will only accelerate the global secessionist movement, starting with November's Catalonia, Spain referendum, and likely thereafter one in Venice, Italy. Regarding Catalonia, It accounts for 25% of Spain's tax revenues. And given Spain is already on the verge of economic collapse, a Catalonian secession would, for all intents and purposes, represent a collapse of Spain itself. And by the way, you can bet that if the Scotland referendum is a yes, the Catalonian referendum will be too. Venice, for the record, accounts for 10% of Italy's GDP. And aside from such a dramatic economic blow, the symbolism of one of Italy's most fabled cities seceding may well prove too much for its already embattled government and economy to handle. Either way, the fiat cancer encircling the globe will have more than just economic implications, and eventually, when it affects the regime's brain here in the States, the currently minor secession movements in California, Texas, and Colorado will become quite a bit more dangerous. For these and countless other reasons, from the pure economic to the black swan variety, we cannot be more vehement in our belief that this may be your last chance at financial survival. And for those taking the initiative to protect themselves with physical precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. Thanks and have a great weekend.